with WTI reaching prices below $70 per barrel yesterday, the lowest level in a month. There seemed to be some upward movement today, yet it's still unconvincing for now. As a key fundamental issue, we note the market worries about a possible recession and thus a weakening of the commodities demand outlook. Yet at the same time, we note that the US oil market remains tight. In this report, we aim to shed light on the catalyst driving WTI's price and assess the future outlook. WTI's prices started to drop once again on Monday, and it's no surprise that the drop is oil prices coincided with China reporting a contraction of economic activity in its huge manufacturing sector for the past month. Market worries for the demand side of oil tended to intensify as China is a major oil consumer, and a contraction of economic activity in the manufacturing sector may have a negative effect also on the demand side of oil. But it's not only China that's worrying oil traders. We are in for another round of monetary policy tightening, with the Fed yesterday hiking rates once again by 25 basis points, and Fed Chairman Powell in his press conference stating that it's not appropriate to cut rates. That would imply that even should the bank pause its rate hiking path, which the market already expects, it may keep rates at high levels for a prolonged period of time. Should monetary policy settings remain tight, that may have a cumulatively lagged adverse effect on economic activity and hence weaken oil demand. Mind you that it's not only the Fed that stepped on the brake, also RBA surprised the markets by hiking rates after pausing. ECB also hiked rates by 25 basis points, while BOE is expected to follow on the same path next week. Hence, to put it mildly, the demand side of the economy seems to continue to be under threat, which may increase the downward pressure on the commodities prices. On the flip side, OPEC and its allies, including Russia, seem to implementing their pledge to voluntarily cut production by an additional 1.16 million barrels per day. It's characteristic that besides Saudi Arabia cutting production, also Russia's Deputy Prime Minister Alexander Novak stated today that Russia is keeping the voluntary production cuts of 500,000 barrels per day from February until the end of the year. So OPEC's production side seems to remain tight, yet that was already priced in by the market, and with no additional production cuts from the oil-producing cartel on the horizon, it may play little role in oil price action. The USD oil production levels had risen steadily in the first 2 months of the year, yet that the tendency seemed to have been halted. We note that the number of active oil rigs in the US remains relatively stable over the past 2 months, just below 600. On the other hand, we cannot miss out comparing that US oil inventories have been dropping, with API reporting a drawdown nearly 4 million barrels and EIA a drawdown of 1.3 million barrels, practically highlighting the tightness of the US oil market as production levels were not able to reach demand. Yet both releases tended to leave oil traders unimpressed as oil prices continue to decline after the releases. Hence, the US oil market tightness seems also to be largely priced in by the markets. Despite a halt in the drop of oil prices today, the rise may prove to be temporary and a mere correction should fundamental worries for the demand side of oil not be lifted, or should there be no additional tightening of oil production. Thank you for watching.